We have people from across the United States. We have California and New York. I want to talk about how New York Jets and Giants are 0-2 to start the year, and the Chargers and the Rams are 2-0. I think the 49ers are 2-0 as well. But let's get it going so we can learn a couple things and I can spend some time at the end answering any particular questions. Everything that we're going to go over is what I felt is important to business owners because the majority of people here own some kind of business. I'm not going to go into so much our tip wages. Are my tip wages taxable or not? Because that's an employee question. If you guys email Priscilla or Aaron, we can send this to you guys directly so that way you guys have it. So the first thing we are going to go over is going to be tip wages from the employer's perspective. So if you have any employees where there's any type of tip situation, nothing changes for the employer. That's a crucial thing that they've really hammered into us. The tip wages is still subject to Social Security and Medicare. Us youngsters still have to fund that Social Security and Medicare, regardless of where that's coming from. So that way the older retired generation can continue to actually withdraw from that. That is still subject to Social Security and Medicare payroll taxes. Your payroll tax situation with payroll company is not going to change at all. In order for your employees who are receiving tip income to claim this, that's all on their personal tax filing. There's a deduction that they're going to have to account for on the personal tax filing. That's not your job. That's not your responsibility. That's all the employees' responsibility to claim those tip wages on their personal filing. Nothing changes for the employers. What's very likely going to happen is you're going to have employees start coming to you though saying, can we change my compensation so I can get tipped income now so I can take advantage of this? That's going to be an interesting situation to see what happens. It will eventually be a court case where the IRS for the state of California, state of New York defeats that. I wouldn't play around with that if any of my employees ask about that. If you want tip wages, go work at a restaurant. The big thing on all this is the SALT deduction is now a $40,000 limit. Before 2017, there used to be no limit. So, it didn't matter how many houses you owned, didn't really matter how much mortgage interest you had. You could have two vacation homes and I could deduct the property taxes and the mortgage interest on those vacation homes. Trump came into office that first term and he adjusted that. Your salt deduction, salt is state and local taxes. We're not talking about salt and pepper. We're not cooking anything here. Salt, state, and local taxes, it was currently capped at $10,000. If you want to look at your 2024 filing, Schedule A, lines 5 and 7. If you want to look at your 2023 filing, Schedule A, lines 5 and 7, that lists your state and local tax deductions. So it's a combination of your property taxes that you're paying and your state income taxes that you're paying and your DMV fees that you're paying. So it's a combination of those three things. You add that all up and you only get up to $10,000, but now you get up to $40,000. So I have two quick examples. One would be for someone that's in New York. If you live in the state or city of New York and I'm paying $35,000 in state city taxes of New York before the limit, I would only get a $10,000 deduction, even though I'm paying the state and city of New York $35,000. But now with this limit being $40,000, that $35,000 that I'm paying, because it's less than that $40,000 limitation, I get that huge deduction. So the difference would be rather dramatic. I get $25,000 in additional deductions, assuming a federal tax bracket of 30%. That is a net savings of just shy of 8 grand. California, we don't pay as much state taxes, city taxes as New York does, but a good majority of Californians own property and also own cars. So I have an example here of someone before the limit. If I was in the state of California, I was spending just shy of 22 grand, 21,500 in state of California taxes. I was paying property taxes of 12,500, DMV fees of $1,000. I would have total deductions of 35 grand. But before this limit came into place, that got reduced back down to 10. Now that this $40,000 limit is in place, I get that full deduction. And again, it's a difference of $25,000. This is going to be material. This is the definition of an impact for high income, high cost of living states such as California, the tri-state area on the East Coast. The only thing is there is a limitation. If your AGI is over 500 grand married filing jointly or 250K single, you will run into some limitations. This whole $40,000 increase actually goes completely away if your AGI is over 600K married filing jointly. You go right back down to that 10. You don't get that 40 grand. If your AGI is over $600,000 married filing jointly, or if you're 300K single. If you're in this threshold of anywhere between 500K and 600K, we're going to run into limitations on how much of a deduction we actually get married filing jointly. If we're single and we're between 250 to 300K single, we would also run into some limitations. This is a huge tax planning opportunity in terms of where we're at going into the end of the year to figure out where our income is going to be. So that way we can make some moves going into the end of the year. So that way we're not running into any of these limitation rules, potentially looking into deferring some income, prepaying some expenses, doing something potentially so that way we could not run into this limitation rule. This is going to be impactful. 15 years ago, when I first got into the industry, before there used to be no limit, which was like the wild, wild west. Every time someone started making money, they'd always say, go buy a vacation home, get another vacation home. And I always wonder, like, why are we getting all these homes for? But it was because there was no limit on any of this. But now there is a limit. The limit has been adjusted, and this will have rather impactful impacts for high cost of living states, high tax states. Qualified business income deduction is permanent, QBI. If you tax plan with us, you're very likely aware of QBI. If not, it's a good refresher. So QBI is qualified business income deduction. If I'm a business owner, I get a 20% deduction from my net business income. It's reported on your personal tax filing. So if I make $100,000 a year in business income, I will get a deduction of $20,000, 20%. So I'm only paying taxes on 80, the difference. If you were to look at your prior year tax returns, line 13 on both 2024 and 2023, there better be a number there. If you're a client of ours, there's a number there. We're working throughout the year to maximize this deduction. But the amount of filings that we see from people coming to us from other firms, someone doing it themselves, that's where it's most commonly missed is when I do the filing myself. Maybe I even have a firm that does my business filing, but you know what? I'm going to do my personal filing. Look at that line. Is there a number there? There should be a number there because you qualify if you own a business. Limitations do exist when your taxable income gets to either just shy of 200, 190, 190, if I'm single, or if I'm 383,900 filing jointly, limitations come into play. And for the most part, the main limitation is the main question that comes into play is how much are you paying in salaries to either yourself or to employees or potentially both. It's the main reason why we always tell people to convert to S corporations, because with an S corporation, you have to show some sort of payment to yourself as an S corporation shareholder. An algebraic formula comes into play in determining how much to pay yourself. So that way we're minimizing the salary, which is a minimization of payroll taxes to yourself, and then also maximizing this deduction. But double check line 13, 2024, 2023 to make sure that there's a number here. We're always trying to figure out what to do so that way we're within some of these limitations depending on your filing status. So that way we're maximizing this deduction. But this deduction is now permanent. This was the filet mignon from Trump's tax bill in 2017. Biden came into office after Trump. The Democrats love this as well. It's bipartisan. Everyone likes this. Less taxes for the business owner, because as business owners, we're all very good at spending money. So if more cash flow comes into the business, we'll spend that very likely, and the government will get their taxes from the next person that we're passing this on to and spending. We did want to touch on the new estate tax deduction. So, a lot of us, our parents are getting older. Eventually our parents will go on to the next life. So just touch on this, so that way everyone's aware, the new estate deduction has gone up to $15 million per spouse. So if our parents, both of them are still alive, that's 15 million for spouse one and 15 million for spouse two that are our parents. So that can be as much as $30 million. And what that means is that if the estate that you're inheriting from your parents is less than that $15 million per spouse, $30 million in total threshold, then the estate that you were inheriting, there is no estate tax on that inheritance. You still have to go and decipher what's within the inheritance to figure out if there's any type of capital gains. If you're going to sell stuff, whatever you're trying to sell within the estate, there may be tax on the actual sale. But in terms of inheriting what you're getting as the beneficiaries of an estate, as the people inheriting the estate, there is no tax if you're below that $30 million, both parents still alive, or 15 million if only one parent is alive. You can essentially inherit for the majority of estates. They're anticipating that with this new threshold, there's only going to be about 2,000 estates per year that would be subject to taxation going forward. Originally, before they updated this, it was set to go to $6 million per spouse, or $12 million combined with both spouses. So this is a dramatic increase from what it was about to go to. States do not conform to this threshold. So you have to check out what states you're in to see if I have a state inheritance situation. The main reason why I'm trying to let you guys know this is because if our parents are talking to you about their attorney saying that they need to do this and that and trying to charge them for stuff, and you're aware that your parents are their estate is less than that $30 million threshold, then you probably want to figure out what's going on. Or if you inherit and you hear attorneys trying to say that we should do this and that to minimize taxes, you probably want to find out what they're trying to do. Because if we're below this new threshold of $15 million per spouse, $30 million collectively, if both spouses are still alive, and we're below that, there's really nothing that they should be doing. It is what it is. We're below the threshold. And then basically the goal with this new threshold is to get as much wealth transferring from one generation to the next generation, because typically what people do when there's little tax involved is they inherit and then they sell, and that just stimulates the economy because now there's cash in the hands of those inheriting, and they typically spend. So this is a great update on the estate tax deduction. Solar energy credits, this is actually a pretty good one. So the vast majority of solar credits are ending this year. The residential solar credit is pretty much 30% of the solar installation. That expires. You need to agree to solar in your primary residence and also get it installed and used. Installed and put into service by 12/31 by year end in order to take advantage of this. After that, in its current state, it will be going away. And then the clean vehicle credit of up to $7,500 that ends at the end of this month. And what I'm starting to see and what we're starting to see is the dealerships are just giving you that $7,500 credit right at the point of sale. There's like a form you sign, something that you're able to just pass on the credit from yourself to the dealership, and the dealership just gives it to you right off the bill of sale. So you have a few more weeks, barring something that Elon and Trump come into a agreement on, but that's set to expire in the next few weeks. Any type of solar for investment or commercial properties, those are still going for about a year. July 4th, 2026 is the new cutoff date for a lot of the solar implementations for investment or commercial properties. I won't be surprised if they extend this even further, just to continue to stimulate the investment commercial space. A lot of these solar energy credits are expiring rather soon too. So if you're looking to make a move on solar, this is potentially the year to do it. Okay, 100% bonus depreciation. What is bonus depreciation? A way to understand it. Typically, whenever you buy an asset, we can't write off that asset up front. We have to write off that asset over time. So a great example would be, let's say I bought $10,000 in computers for me and my staff. Regular depreciation, you have to figure out how long is this asset going to last. So computers typically last about 5 years. So even though you're spending $10,000, even though you're entering into an agreement to spend $10,000, with regular depreciation, I have to write it off over time. So I get a $2,000 deduction year over year for 5 years. So that $10,000 out of pocket expense that I'm at right now today, 2025, I still get the expense, but it's spread out between 2025, 26, 27, 29, 30. 100% bonus depreciation. There's also another term called Section 179. I'll get to that in a second. But what a 100% bonus depreciation does is it allows that business owner that's buying assets, that $10,000 in computers that I'm buying, I get to write off that full $10,000 the same year that I'm buying it. So if I'm buying $10,000 in computers, $100,000 in equipment, I'm able to use 100% bonus depreciation and I get that deduction in full. What's great about bonus depreciation, and then there's this other depreciation called Section 179, is bonus depreciation can actually create a loss. And depending on what's going on with that loss, I might be able to have my loss from my business offset other income that I'm earning either from another business or from a spouse, et cetera, et cetera, et cetera. Whereas Section 179, Section 179 and 100% bonus depreciation are basically brothers and sisters. They're the same thing. The only thing is that with Section 179, one, it's capped. It's capped at $2.5 million. I can only write off everything in full up to $2.5 million with Section 179. Bonus depreciation has no limit. There is no limit on how much you can buy to get a deduction with 100% bonus depreciation. So that's the first kind of issue with Section 179. One, there's a limit. Bonus, no limit. And then Section 179, I can't create a loss with the depreciation. Once I get my taxable income down to zero, any excess depreciation gets carried forward into future years. Whereas with bonus depreciation, I can create a loss and that could potentially have impacts on other income that I'm earning. So I have a quick example here. So Section 179, I have 250K of business EBITDA, earnings before income tax depreciation and assets. So I have 250K of net profits before depreciation essentially. And I spend 350K on assets. I go out and buy some work trucks, whatever. I spend 350K on assets. With Section 179, I would be able to write off that full 350K, but I can only write off up to my EBITDA, my 250K, and then net income gets down to zero. That remaining depreciation of 100 grand, because I have business income of 250, I spent 350. That remaining difference of 100 grand gets carried forward into future years. I can't create a loss with 179, but with 100% bonus, I have $250,000 of EBITDA. I spent the 350 grand. I now have net income of negative $100,000. There's nothing to carry forward into future years. So now I have a business that has a paper loss of negative 100 grand. So if my spouse is making 100 grand, I could potentially offset those. And then if I don't have any other income, my spouse doesn't work, I only have one business, then that creates an opportunity that we can start looking at. We can start looking at any retirement accounts. It might be a good idea to convert some of my traditional retirement accounts, traditional 401ks, traditional IRAs to Roths. Now I'm creating some taxable income to offset these losses. And then now I've just converted a decent amount of my retirement to a Roth. And with Roth, you can just pull that out whenever you want and it's tax free. So bonus depreciation is like the holy grail. And they've continued this. So I can only imagine how many cars will be purchased this year, how many jets will be purchased this year, and we'll figure out how to deduct those. The last thing here is tenant landlord improvements. That has been expanded in terms of what is an improvement. That definition has been expanded really, really well, in my opinion. And then it combines with 100% bonus depreciation to really create some opportunity for those of us who are tenants and have a good relationship with the landlord. Some of us are both the landlord and the tenant, or the landlord. Whatever you are in that relationship of having some sort of real estate, this only applies to commercially used property. It does not apply to rental real estate. It only applies to commercial real estate. Commercial, I'm running my office through real estate. I own a commercial building, even though commercial could be considered residential, but this only applies to commercial. Anything I spend, I can take 100% bonus depreciation because 100% bonus depreciation is now in effect. So they've expanded the definition to security, HVACs, walls, lighting, fixtures, electrical, plumbing. There's a lot that is in this, but these are like the main things. I'm a business that I have 250K of business EBITDA, and I have an HVAC upgrade that I'm looking to spend $100,000 on. An HVAC upgrade, let's say it's $100,000, we would typically need to deduct that over the useful life of 20 years, depending on what we go with, 15 years, 20 years. Okay, we typically have to deduct that over a long period of time. So you get a $5,000 deduction per year, essentially. But now with this expanded definition of what's an upgrade being more favorable and 100% bonus depreciation, if I'm improving the HVAC and it's $100,000, I could write off that full $100,000 in the same year that I'm buying it. And again, that could potentially create a loss for us that we can deduct against other income. This is really, really, really good. What it does not include, it would be elevators. So I can't go out and buy an elevator for $100,000 just so that way I can show it off. Instead of having to walk up the stairs, I'm just going up that elevator. But elevators, escalators, structural framework definition is very, very nuanced. We really potentially need to explore that. Beams, foundations, okay, and then any outside improvements, anything to the outside of the building. So it's primarily the interior of a commercial property. There are some rules though, in terms of if I'm creating a loss, there are some rules between passive and active income that we would potentially be limited to. Passive activities are one set of income. Passive activities where my money's making more money is one set of income. Active income is income where, I'm working for it. There's rules on when those can and cannot be combined. So we would have to potentially look at whether or not we can create a loss with this entity, use that rental property entity, and can we offset that against my spouse's wages, et cetera, et cetera, et cetera, like we can with when I'm creating 100% bonus depreciation with a business where it's an active loss, I can offset that against other active income. So we just have to visit the rules on passive versus active. I feel like this is really, really needed, especially where the real estate market is, especially the commercial real estate market. This is really, really good to see. And I did want to just go over qualified small business stock just real fast to close this off. Okay, qualified small business stock, it's unique to C corporations. C corporations are primarily used whenever venture capital or private equity is involved. You also need to be a C corporation in order to be publicly traded, not an S corporation, but a C corporation. If you have a great idea and you have private equity or venture capitalists involved, they force you to become a C corporation. C corporations are, from a tax perspective, the worst way to run a company. You're injected with capital, so the government's just trying to tax as much as possible with that capital investment that you're getting from private equity venture capitalists. And then if you're publicly traded. But if you're a small business C corporation stock owner, before this change, you would need to hold that stock for 5 years and you would get a up to $10 million deductions. If an investment opportunity comes your way and it's a C corporation, it's attractive because that stock could build. If that stock was worth $15 million, I would get a deduction of 10 million and I would only have a gain of five, the difference. It was only $10 million and I had to hold the stock for 5 years to get this deduction. Now, with this new rule, it's up to $15 million. So now I can hold C Corporation stock if I'm an investor. I get a deduction of $15 million. They've also expanded the definition of what a small business is. It's basically any type of private equity or venture capitalist backed company that's not publicly traded is now pretty much qualifying for this. And then the holding period has changed. If I hold it for 3 years, before I had to hold it for 5 years in order to get that $10 million. Now, if I hold it for 3 years and decide to sell, I get 50% of the deduction. If I hold it for 4 years, I get 75% of the $15 million deduction. If I hold it for the full five, I get 100%. So they give you some flexibility in terms of if you're into something on the front end and you're looking to liquidate, you have some nice relief there. So if I have a $15 million C corporation stock and I held it for 4 years, first of all, hell of an investment. If I had it for 4 years, I would get 75% of the $15 million deduction, which is 11,250. So my gain would only be $4 million on that $15 million liquidation. This is really, really good just to keep in mind if any type of C corporation stock investment comes across your table. So that is the major aspects of the big beautiful bill that I feel is very relevant to business owners in 25 minutes. A lot of great action here. We have our company team and contact information.